Introducing Decoding Digital Lending for Vehicle Finance, how to enhance process and operations. Before I highlight today's panelists, here's a quick summary of the event agenda. Bridging the Gap, an overview of dealer and lender challenges, business drivers, technology insights for a strengthened partnership between dealers and lenders, how to gain technology insights and a competitive advantage, leveraging a fully digital ecosystem, benefits and process analysis. And now I'd like to take a moment and introduce today's presenters. First, we have with us Theodore Popiliou, Director of Value Engineering at eOriginal. With over 20 years experience, Theodore is a veteran of enterprise technology implementations. He's spent his time consulting and architecting complex solutions in the federal, financial, and retail space, where he is focused on identifying and solving complex challenges, always with proven, documented value analysis and ROI. As a member of the eOriginal team, Theodore has applied his experience to the ABS space across verticals, including marketplace lending, equipment leasing, vacation ownership, and automotive finance, where he consults with originators, large non-prime funders, investors, and custodians. His understanding gives him a complete end-to-end understanding of today's digital technology and challenges. Also with us today is Georgine Muntz, Chief Operating Officer for Defi Solutions. Georgine has been in the technology and finance sector for over 25 years and spent 10 of those years in auto finance, directly as a lender at AmeriCredit and Xterra, and now as a vendor at Defi Solutions. She is passionate about getting paper out of the process to save lenders time and money. Her experience on the inside as a lender makes her painfully aware of the lender challenges with compliance technology and integrations. Thank you, Theodore and Georgine, for being with us today. And now I'll pass the presentation over to Theodore.
Webinar is going to talk about how within the auto industry, technology itself can help establish best practices, enforcing those throughout the ecosystem, and bridging the gaps between the two key players in this space, the dealers who operate as the originators and the lenders and the secondary market that is invested in the loan process itself. So we'll talk about how technology today has progressed over the years, and there are solutions out there that will enable both parties to build on the trust regardless of what their particular objectives are within their core value chain. Some of the challenges that exist today, both for lenders and dealers, really have evolved out of the many years of technologies and the limitations of technologies in the past, and the demand on organizations that keep focus is not technology, them needing to figure out the way how all these work. So these technologies have grown within the ecosystem to address specific point problems, and thus have created a siloed approach where a lot of information is locked in and not easily moved through the process and visible by the key parties in that process to make decisions. There is this lack of transparency and a single point source of truth where everyone feels confident and trusting of the information itself. Because a lot of the technology is involved around the particular operations of either the lender and or the dealer, a lot of the last mile is still left as paper. So loans can be decisioned, and a lot of information verification of the buyer's identity can be done electronically, but we're still producing paper loans that get executed with wet ink. And that process has to then, the documents themselves have to move to the next stage into the lender's hand. And this creates delays. A lot of creative agreements have been put in place to expedite the booking, but ultimately it hinges on the verification of that document. We'll see how today's technology can bridge that particular gap. We've also seen that because of the paper process, that up to 3% of all loans executed tend to not get booked because of errors, omissions, even missing signatures and initials, which causes not only a lot of additional work and costs within the process, but also results in lost revenues. And with the the cycle leveling or decline that's happening now, natural decline within the industry itself, having the ability to show not just a well-defined process, but also increasing and improving the efficiencies within those processes enables the margins to grow even in a tighter market.
Thanks, Theodore. With that, I will grab the next few slides and walk through a couple of points around technology and dealer and lender interactions. Many of you on the phone today are primarily indirect auto lenders. We're going to use the term lender throughout this presentation fairly loosely in that we're referring to an indirect lender primarily. It could also apply to a direct lender who does auto lending. And then Theodore will also talk about the lender being often the senior lender or even moving throughout to the ABS process. So when we use dealer lender on this slide, I'm talking about the dealer as the primary initial lender and then the lender that often will purchase the retail installment contract from that dealer. And for those of you who've been in the industry for a while, you know that we have a lot of similarities between the dealer and the lender in that we are both trying to maximize results. We want to have speed and efficiency. The dealer focuses more on the consumer and his CSI or his satisfaction index, and he also looks very closely to what the manufacturer, if it's a franchise dealer, is dealing with for that particular dealer. They want to do things like manage inventory, maximize the profit on each deal, build their customer relationships, stay compliant. You're going to see that across all areas. And then they, of course, want repeat business, and the lender has a big play in that area of it. Lenders are mostly focused on making sure that they get the right quality loan and they price it properly for risk, and the reason they look so closely at these is it's very important to their margins, and it's also important to their access to the capital market. So next slide is going to be the technology, some of the technology requirements. So if we move on to that next slide, we have some insights or some of the things that you want to think about when you're trying to use or build technology to bridge the gap between the dealer and the lender. These are some of the key points that I think you should keep top of mind. You want to invest in technology that gets it right and keeps moving forward. I think many of you know that it's very easy to fall into a trap of installing technology and then forgetting about it and getting behind and not being able to keep up. So find technology that's getting it right and moving forward. And then the other thing is you want to find some technology or technology partners that are willing to work together to find solutions that work for both dealers and lenders, and I'll even throw consumers in as well, with web-based shopping and millennials becoming a bigger and bigger part of the buying process. Having a solution that works from the beginning to the end, from the first part of shopping through financing, through to the lender, and then on to the capitalization process is important. Solve for now, but solve for what your problems you're having today. So you've got to solve for your current business problems, but keep an eye towards the future and make sure that your technology that you're choosing and using is doing the same. And then always, if you can, look for solutions that break down some of the silos. I think we all know how hard it is to change ourselves, much less get other parties to change. So wherever you can let the technology help break down some of those silos and share the important information, the better you're going to have going forward with your customer experiences for dealers and consumers. Errors, omissions cost us all a lot of time and money, so look for solutions that reduce and streamline any opportunities for errors.
leverage providers with high compliance standards. This is almost a given, but it does require more time and attention to make sure that the people you're using as your technology providers understand your particular compliance requirements, which we know are can be complicated and numerous in auto finance. And then also keep an eye on what's new and how it can help you. Believe it or not, other industries have done things well ahead of us and kind of broken down some walls and got things pushed through. And eOriginal in particular has worked probably more outside of auto than inside with many of their forward-looking technology like e-signature. So look out for what's out there, what's new, and how we can bring that benefit into auto, especially in times like these where we're all looking to get the best return we can for and the margins we can on the deals that are out there. You can move on to the next slide.
Jean, if I can add to that,
please do.
You know, I see in the space really when we talk about the compliance pieces, really two core components. A lot of it is on the front end when we look about consumer verification and being able to you know, protect the consumer rights and meet the compliance components there. And that's driven by a lot of great technology in the space today that, as we'll see further on in the presentation, tie nicely into that loan origination process as peripheral contributors to the space. The second part of it is really the post-execution part of the compliance that really it doesn't depend on how the contract was put together from a compliance perspective, but more about how does the secondary market, lenders and know and feel confident in what is produced at the origination point. So we look at, you know, the legal precedents around being able to perfect on assets and being able to protect my first security interest on the note and mitigating my risk. So when we look at the end-to-end components of all these solutions, working very closely, as you pointed out in the slide, from the two-party perspective and agreeing on what is that standard that needs to be met is key, because in many ways, we, the vendors, have done a disservice to the industry itself by advocating very narrow-focused solutions and not necessarily looking at the bigger picture. And unfortunately, the industry itself has to figure all that out. So hopefully, you know, at the end of the day, this presentation itself will help people navigate the broader sense. But again, working together and agreeing with your lenders on what is that baseline you need is key.
Yeah, that's a great point. I often think that the end of the process is once it's been collateralized and securitized, but the asset, of course, lives on from there, and making sure that you carry all the right information across through each step is important. So the next slide, we're going to just touch on a few key points or considerations that the dealers have to deal with prior to the lender getting involved. They have to have a secure application process, and I think most of us are aware that Dealer Track and Route 1 came into the industry a little more than 15 years ago and enabled the secure processing of most of the applications that go through, but there are also other sources and other portals out there that help facilitate that. Inventory control and tracking is extremely complicated and integral to what dealers are dealing with from a shopping experience and from their own asset control and sales perspective. And then you have the credit assessment. They are the original lender with a retail installment contract, so they are doing some initial credit assessments to determine where and how they might place that contract going forward. Customer marketing is key. They've sheltered indirect lenders from a lot of the marketing aspects of the car buying process, and so they have to have systems and technology to facilitate that. So lead generation, tracking, and processing is important. customer shopping tools. They've got to be able to get their inventory and other information available to customers who are shopping online who are not yet in the dealership. And then once they're in the dealership, there's also technology that can enable the sales and the F&I process. And then, of course, the one that ties the lender and the dealer together is the contract creation, processing, and funding type technologies. So those are some of the key highlights. With that, I'll let Theodore chime in, and he can walk us through a few of the lender considerations.
Thank you, Georgine. Yeah, I really, if you look up at the ecosystem at the dealership, this is the bridging point from taking all that information that's been captured, making the decision, and then preparing those documents for execution. And as I mentioned earlier, that historically has been a out-to-paper process where we wet ink. And a lot of it for the last probably, 8-9 years has been based on reluctance to move to electronic or concerns that electronic is not legal, binding, or acceptable. Only within the last 2 years, have moved rapidly past those points. And as Georgine mentioned, in my capacity here at eOriginal, we work in other industries, such as marketplace lending and equipment leasing, where all of them are adopting very quickly the full execution of the electronic paper end-to-end and the contract end-to-end. So really, as a vehicle to move into the post-execution space is the electronic execution and signing of those documents. And really what a lender's looking for here is the ability to continue what they're accustomed to doing in the paper world, and that is to perfect. And really the two key points around perfection is, can I prove that I am acquiring the original wet ink signature, and can I get that into my possession? So in the same manner, the electronic solutions do that by creating what's called an authoritative copy. It's the equivalent of the original, the wet ink signed document, and moving it into their control or possession through the internet into a electronic vault. Where they can manage and control that particular asset. So those are two key considerations that aren't driven so much from a technology perspective, but more so from a compliance and a legal perspective, again, around mitigating risk. And this is where I think, the originator side, the dealers, are able with, collaboration, the lenders can improve and implement best practices to reduce and eliminate a lot of the inefficiencies in the process, and at the same time increase that trust between the two parties. If we're looking at this process end to end, we can, and they're connected, we can see how a lot of the information that's being captured for the decisioning and the verification can move through the process uninterrupted and be available to all the parties associated. And that's where, again, the ID verification and the document verification can be done on the post-execution side, because that data accompanies all the necessary documents within the deal jacket. Along with the information that's being passed along, the system itself is capturing countless amounts of information about the process itself and the parties that are involved in that. And that really creates an extensive audit trail of the process and evidence that a best practice process has been in place. The key around that is that it becomes now indisputable to anyone looking in that there is a defined process, and that process meets the highest standards and provides comfort and assurance to anyone involved that what is being delivered to them is of top quality. And don't forget that a lender isn't the stopping point. There's continuous change of hands that occurs upstream, and these assets can get leveraged multiple times. And every time that passing occurs, the same level of scrutiny gets applied to the pool or the individual asset. So creating this audit trail and this level of information and putting in place a system solution that meets those standards makes that process a lot more efficient, quicker, and less costly. If there's anyone on the phone that has tried to find a source of funding, knows that it is difficult to go beyond what relationships you have. And being able to have a solution that reduces the time to build that trust is key.
Yeah, great points. This next slide, it's very busy, somewhat intentionally. I wanted to give everyone looking at the slide an understanding of why it's taken us so long and been so complicated to get all these pieces working smoothly together. On the left-hand side, you see a typical ecosystem for a loan origination system, and that's where Defi specializes. And what you see on the farthest left of this slide is application sources, which can be many and varied. The big ones, DealerTrack, Route 1, Credit CUDC and Cuddle do some credit union processing. I have generic listed there as anybody's website or anyone's custom-built portal can produce applications. Once that application's produced, it comes into an origination system that has to perform many different activities on that application. Typically, the first and foremost is attach that to some credit data. You've got your credit bureaus, TransUnion, Experian, Equifax. You've got a lot of third-party data that's becoming more and more useful and powerful, things like LexisNexis and Factor Trust. You have Work Number to help you prove income and proof of income and employment. You've got texting solutions. You've, of course, got servicing systems that are then going to start managing the application once it's funded and processed. On the other side, you have clients, lenders, and consumers using different types of devices, different browsers. You have the vehicle value guides coming into play for vehicle valuation and other risk-based components of the credit decision or the approval decision process. So all of that comes together in the LOS, and then when you've got things tied together properly, that information, a lot of important information, can be carried on downstream, like Theodore mentioned. And so to make this point a little more real, I kind of mentally walked through an example that I think might be familiar to many of our indirect lenders. You get an application that comes in, let's say it comes in from one of the portals, and there's a red flag, an identity theft issue with that particular consumer's credit information. So at that point, you've got a compliance issue that has to be dealt with. With the right technology, you can take that information, which would be a flag that requires some additional processing and verifications. We call them STIPs most often. There's an additional STIP that requires the dealer to capture, possibly to capture the driver's license and another form of photo ID for that individual. And so the LOS, if done well, can then let the dealer know immediately and seamlessly that these additional steps will have to be taken before an approval can be issued, and at the same time have that information tracked into the LOS and carried along with that contract for the future. The lender themselves might have a stipulation that says, on top of making sure that the dealer collected the proper verifications on behalf of the lender, they also will make a phone call to a bureau-identified telephone number. So the STIP will be to contact that consumer to confirm that the identity is, in fact, the consumer and not the identity thief that originally had created the flag situation. So that information all gets carried along with the deal, entered into the system, and pulled forward. At the point of contract and contract funding to the dealer, that information, that metadata, can stay with that deal along with the electronic signature, electronic contract, or scanned image that can become an original electronic contract, stays with that deal and can be passed over into a system like an eOriginal where it can be securely tracked and vaulted. Both the electronic documents, the signature, the metadata, and the proof that the proper compliance steps were adhered to for that particular consumer. So if you kind of follow that thread of compliance from beginning to end, you can visualize, or you know for sure how complicated it is to keep all those pieces together in a compliant and smooth fashion. So with that, I'll let Theodore take the next slide and talk through the ongoing process.
Thank you, Georgine. I would say that the loan origination system really is the connection into the back end and the orchestrator of the origination process, as Georgine pointed out in her diagram. I also want to, before I jump into the post-execution side, want to talk about the SaaS growth in this space and how much it has enabled the ability for all these particular technologies to start speaking together and providing this cohesive process. If you look at historically the notion of organizations wanting to install solutions on-premise, it automatically creates an island. And in an industry that needs continuous flow between these different islands, SaaS solutions has really enabled that to happen. I think from the origination side as well, from the loan origination system, the SaaS environment and the two components really have enabled now, whether you're taking advantage of it or not, the shift as we're seeing in the market as well in how we go out to and find our customers. And this, again, is a multi-channel approach and supporting these multi-channels. But 3 years ago, 4 years ago, the notion of going out and targeting borrowers directly seemed like a daunting task. Marketplace lending, which is another space that eOriginal works in, has shown that that is a viable model. And we're seeing that adoption in other industries as well, automotive being one of them, where there are relationships either directly with a customer base or establishing partnerships to market to consumers directly, and even between the lender and the dealer, where long-lasting relationships have been established, where there are still some portion of those contracts being executed directly and not through other channels. So having a platform that enables all those options and gives you the agility you need as the market changes is key, and I think the SaaS model very much enables that. With that said, moving over to the post-execution side, and the touch point again is passing the document off to an electronic signing solution to continue and bridge the process to be fully electronic. That last mile enables the contract to be executed electronically, legally, and moved to the proper control based on who needs to have ownership. And in many cases, if you look at what the vault does, that is what establishes control. And so dealers themselves, depending on the agreement that they have with the lenders, may or may not need to take that first control of the asset. In some cases, dealers we've seen hold on to portions of their assets themselves. So having their own vault and having an electronic signature solution that complies benefits them as well in the long run, regardless of whether they're leveraging the assets in the secondary market. Once those assets have been passed to the lender, as we can see in the top section of the diagram on the right-hand side, the dealer then can pass that control, if needed, directly to the lender, or the lender themselves receives the fully executed contract. That provides a complete visibility into not just the deal jacket itself and the content of the deal jacket, but all the metadata associated with it. So now I have the ability to rapidly verify that what I agreed upon from an underwriting and decisioning perspective was properly executed, and I can ensure that I have a legally binding, fully executed contract within my vault. When I create pool large enough and I need to leverage that in the secondary market, the solution that the vault can provide, especially if it's in the SaaS environment, is the ability for the parties that are reviewing these pools to have insight directly into what is being offered up and being able to do their due diligence. So regardless of whether I'm selling my assets outright to another source or I'm leveraging these assets through a collateralization or syndication, I can do that without having to do any heavy lifting on my end. A good vaulting solution provides those capabilities as part of the offerings. There are a lot of ways to establish control. In many cases, from paper, we still depend on custodians to take that control on behalf of investors. They are part of the ecosystem solution that we've established as eOriginal in the space and have many of the well-known custodian banks on our platform accepting today electronic. So if this is a process that you're looking to implement or something that you're trying to do or doing today in paper, there are solutions like eOriginal out there that can support this and produce a lot of the efficiencies around managing these contracts and pools electronically versus trying to do that in paper. On this slide, we really wanted to just graphically show the process as it occurs. Most of you are familiar with this, but obviously a borrower comes into a dealership and identifies the car they want to buy. The contracts are drawn up and executed. Those then need to be moved through the internal systems of the dealership so that they can do all the verification, necessary decisioning that's needed. Once that's all done and the contract is fully executed, it moves into the post-execution space in the hands of the lenders, where they are able to not just manage the assets themselves and do the necessary due diligence on those assets, but they're also able to monitor and identify the content of their pool, their portfolio that they have. Those then get moved into, as needed, to be leveraged in the secondary market. They can, through the vaulting interface, identify and do the loan segmentation as needed for securitization, and finally move all those assets into its own vault as part of that securitization for the purposes of perfection of the investors in those pools. Georgine, would you like to cover very quickly the benefits for the dealers? And we'll wrap up and start questions.
Yeah, sounds good. I think we're about on track again. So benefits for dealers having this seamless scenario that we're trying to lay out today is that they can automate some of the necessary steps for compliance processing, which will, for them, reduce deals that they end up having to buy back or that they're not able to get closed quickly. Speed is important with millennials and others. Getting people in and out of the dealership quickly and efficiently is top of mind for them. They get measured on it and they get scored on it often, so it's important. The other thing is, dealers also have capital constraints. They need to get additional inventory in to get more sales, and having a faster funding cycle is beneficial to them. They'll get their funding quicker. They can get more inventory on the lot, get more cars sold. Reducing overhead and cost are important. Dealers spend a lot of money on paper and shipping today, and that comes straight out of their margins. Integrated compliance from start to end improves quality both for the dealer and then, of course, for the lender. And having better quality paper allows a dealer to have access to more and more sophisticated lenders, so that gives them more opportunities to grow their business. Automation improves CSI in that it does help with speed to serve the consumer, and then also the hassles in the experience are less if the consumers can use texting and their iPads and get PDFs rather than stacks of papers to take away with them. And you want to hit on the lender points? Yeah.
Sure, and I wanted to kind of also start at the lender side with an across the board that we're seeing this a lot, especially being in other verticals, that the consumer expectation has changed, and the willingness to either interact directly with a human in the manner that it's been done has shifted. The notion of leveraging people's devices in the process really gives advantages to the originators in who they attract into their dealership. So at least for now, I think it becomes a competitive advantage based on the demographics and markets you're targeting. So obviously the executing a document electronically creates some of that experience directly with the consumer, while being able, as Georgine mentioned, to provide feedback while they're signing or buying a car through their device, through text and so forth. Again, creates the experience that users are now starting to lean towards. With that said, we look at the lender. When I'm providing these solutions to be done electronically, I hopefully am attracting more clientele and increasing my potential market to generate loans. But more importantly, if I'm doing it electronically, I can really reduce the errors associated with. And as I mentioned earlier, in many cases, this has a direct impact in your revenue. There is definitely revenue leakage associated with that when there are errors, when the process is error prone. As a lender, going to the secondary market is always a challenge. I may have established relationships, and those relationships and processes have been vetted and well-defined. But as I grow, or as my needs for assets increases, going to find another source is time-consuming and costly. And so having accepted processes that the industry is familiar with, and that the upstream investors and lenders and funders are familiar with, can really shorten that cycle and provide greater access to capital. Being able to reduce a lot of the cost of managing paper and shipping is obviously a key point as well. And finally, communicating the information electronically can reduce the ongoing cost of servicing.
And Theodore, I just wanted to touch on that last point, that when you get permission to communicate electronically early in the cycle, you get opportunities to carry that through. And this is for, the first lender who services the loan. They can take that electronic approval for communication and send welcome letters in email, send statements and text messages for reminders and collections. So it's a real bottom line impact for many lenders.
Great. Well, thank you both. We've reached our Q&A portion of our event, and we actually do have quite a bit of questions. So with that, I'm going to kick off a few of these. The first one that came in is, normally we require notarized powers of attorney on titled vehicles. Do you know about any progress on e-notary with vehicles?
Yeah, I can take that one. So there are electronic notary solutions that are offered in the marketplace. eOriginal has partnered with several of them. It seems to be that it's kind of coming down to two separate models as far as how it's being deployed. One is a very central or remote notarization. The other one is really establishing an electronic footprint of the existing notary world. So if you have a notary in your offices, they can register and become an approved electronic notary. And most states do accept them. But this is a conversation that needs to happen both with the technology vendors, which in this case we'd be happy to talk about that with you, but also getting the comfort level of your legal counsel and anyone in the process post-execution that might require that as well. Never hurts to get a lot of opinions and approvals before you pull the trigger on these things.
Okay, great. And along the same lines, another question is, how do state laws that require an ink/wet signature limit what can be digitized?
So in certain states where auto contracts can't be executed digitally, obviously you're forced to push that out into paper. But if we look at the UCC that governs chattel, and specifically Article 9-105 for electronic chattel, it actually accounts and supports the notion of the change of media. So if you have paper and want to convert it to electronic, you can do that with what's called a paper in, or if vice versa, you have executed electronic and want to convert to paper, you can do a paper out. The key around that is ensuring that you have a process that is well documented and captures a lot of detail and information so that that can accompany these documents within their life cycle and can show that the conversion happened in compliance. So paper in and paper out are supported capabilities within eOriginal signing solution, which would enable you then to either migrate what you have already executed and stored electronic, or more importantly, to maintain a hybrid offering and the origination with a consistent all electronic post-execution back-end management solution.
Great, thank you. One more, this is related to ROI. What are the proven cost benefits for companies that have implemented these processes? Georgine or Theodore?
Can you repeat that one more time?
Yes. What are the proven cost savings for companies that implement these processes?
So for example, I'll give you an example of the lender side. If you take a lender and just remove the cost of storing paper, so everybody has different costs, but you know that there's physical space, there's filing cabinets, there's cost related to managing the documents. Often they have to take the documents and vault them in a physical storage like an Iron Mountain. So all of those costs are tangible. You can add those up and calculate a return on investment on those. From the dealer perspective, the dealer's real costs are shipping and copying contracts. Often right before a dealer sells a contract to a lender, he packages it up, puts it in a FedEx or similar overnight envelope, pays the shipping on that, pays for the paper to make a copy of it in case it's lost in the mail. Then the dealer keeps the copy, sends and pays to ship the document. The document then gets handled by the lender. Many times lenders will pay a third party to open and scan that paper into their system. So those are real costs that you can quantify as a lender that you can avoid if you're using electronic. And then downstream, this was the one that I think was most surprising to me or new to me based on my experience more on the lender side, was that that last mile that Theodore's been talking about is that the capital providers, the senior lenders and the asset-backed security bond custodians then also have many costs to manage that paper. That's real. So when I spoke to one of the top senior lenders in our industry about the process that we use at Defi that leverages the paper in process, they were explaining to me that there's real cost to moving a securitization pool or a collateralization pool from one place to another, or to manage the custodial tracking of that. And so there are costs in every part of the value chain that can be quantified and reduced based on using the right compliant technology to replace the paper process. So it's real and tangible. Every company will have a different ROI and different costs. The larger you are, typically the lower per unit cost you'll see, but the costs are real and they're not complicated to measure.
Yeah, to add to that, and I think the audience and my interactions with customers, there's always a push to get a real number. And from my perspective, I'm always hesitant to give you an arbitrary number based on someone else's process versus what you're doing. But in don't hold me to this kind of statement. We see that from our perspective of the electronic execution of the contracts and the post-execution, you could see savings or ROI of around 300% all the way up to 800%. Again, I'm broadening the industries where some of the costs become a lot higher than what I typically see in the auto space. But to Georgine's point, if you really look at the very tangible components of not producing paper, not moving paper around, at the cost of shipping, the risk of having not in good order, not fully executed contracts that ship back and lost, and broaden the scope into what I would call more indirect savings or risks mitigation. These can become very high return solutions. But if sticking with just the physical or the cost and time consumed, you could definitely see a well-implemented solution can produce a 300% ROI easily.
Great. Just probably have time for one more. This one is regarding Vault. I'm not leveraging assets in the secondary market, so why do I need a Vault?
Yeah, that's an excellent question. In many cases, the assumption is that I don't have a personal need to protect my assets when they're tied up in a contract. And so my question always is, what do you do with your physical paper? Do you leave them sitting around the office, or do you collect them and protect them in a secure file cabinet or vault, water protected, fire protected? Same concept here is this is the representation of your assets in paper that are tied up now and could have been used, for other activities. Do you want to just leave them around? If you ever need to defend them or show that you have first security interest in those assets, the process that you have is what's going to get scrutinized. So, creating an electronic document and storing it in a file system that anyone can get to, and I can make unlimited copies and mail them around, leaves a lot of gaps and questions on whether you are truly in control and possession of those assets and have the first security interest. So I would say, determine what your risk tolerance is, and decide what that's worth to you in investing in a solution. And the latter piece is obviously today you don't leverage them, but if you're growing and if that is the purpose you're in business, will you need to leverage those assets in the future? If that is a possibility that you will need access to funds, you're better off having a good process from the beginning than trying to comply to an investor's demands or taking less on the value of the assets because you didn't do it right in the first place.
Great. And final question. What should lenders consider when choosing technology partners to automate contract processing? Georgine, did you want to take that one?
Yeah, I can take that one. Let's see. I was going to add one point to what Theodore just said, and that is that data security, a lot of less sophisticated or maybe very distributed lenders might have copies of documents that has PII all over it. And with the CFPB and other regulators looking at smaller and smaller lenders, having pieces of paper laying around offices or stored unsecurely could be a real cost and a real problem. and they don't really necessarily care how much it costs you to pay the fines if you do get caught in a situation that is not, not ideal. It could cost real dollars from a compliance perspective, even if you're not securitizing or collateralizing. But aside from that, from the technology side, which is where my passion is, of course, finding a technology partner that understands compliance in finance. That's important. A lot of the more of the fintech providers, they're very good at technology and they understand the consumer experience extremely well, where I find that they have less experiences in that compliance understanding. They'll take it for granted or take it too lightly. Experience with automation, even if some things are manual now, but they need to be automated in the future. You want to make sure the technology you choose enables you to move progressively towards where you want to go, which automation is definitely one of the places we're seeing in decisioning and in compliance-related areas. Industry understanding is very helpful, and that may not just be your industry, but understanding industries of finance and what options are out there and what are compliant. I found that auto often lags a few of our peers in the finance industry, like credit card, maybe mortgage. So having a deep understanding of the real realities and possibilities is extremely helpful for the technology. And I always like to find somebody leading and driving innovation, because what's great today is not going to be great in 2 years. As we know, technology moves so quickly, it's amazingly hard to keep up. So look for leaders that are driving innovation. And I think my newest focus has been on collaboration and support. So people who are seeing the big picture and linking together best providers are going to offer lenders and dealers better options for that seamless experience. So those are a few areas I'd focus on.
Excellent. Thank you for that insight. And this does lead us to the end of our presentation. So Theodore and Georgine, thank you so much for an informational session. And for the attendees that came on and we had some audio issues, I apologize. We will be emailing out a recorded version with the front end of our presentation intact. So look for an email from us tomorrow. Additionally, if you want more information, we have eOriginal and Defi contact information up on the screen. And again, we'll include that in our follow-up email. So thank you all for attending, and this concludes our event for today.